So recently, as many of you know, the Fed reduced the interest rates by 0.5%, right? So 50 basis points. It was the drop. It was a little bit larger than was anticipated or expected. I think lots of market forecasters thought it would be about 25 basis points, but it was a little bit larger. So what does that mean to you? If you're a private lender out there, you're probably trying to figure out is do the Fed rate cuts have a direct relationship to either the short-term loans that I offer, my bridge loans, my fix and flip loans, my ground-up construction loans? Do they have any effect there? And similarly, as many private lenders are offering DSCR loans. DSCR loans are term rental loans. They have a 30-year term to them, and they are typically securitized or they're sold to insurance companies. And so there's really different marketplaces these loans typically end up in. And as you can imagine, these sorts of products have very different results when it comes to a Fed rate cut. So what we wanted to do was make sure we took this macro event, the Fed dropping its interest rate, and give you a direct application to your world. So let's look at the DSCR loans first. And whenever I'm talking about data, I'm always talking about it from the perspective of Lightning Docs. For those that don't understand what Lightning Docs is it's the largest private lending software system that produces business purpose loan documents. It's used by more than 200 lenders nationally. And so it's a really good index to give you an idea of what are the actual interest rates that current private lenders are using when they are offering their loans. So let's talk about the DSCR loans first. DSCR loans track heavily with the 10-year treasury rate. So actually, they don't really care that much about what's happening, what the Fed funds rate is. That's not how they trade. They trade similar to conventional mortgage loans based on 10-year treasuries. So let's look at 10-year treasuries first. When you go back to April of this year, 10-year treasuries were trading at 4.70%. That was their high watermark. The lowest that we've seen it come down to is 3.70%, and we saw that on September 22nd. And so what you're seeing there is a full 100 basis point spread or 1% drop in the treasury rates at the end of April. And when you look at that exact same time period and you track DSCR loans, they were trading at 8.03% during that time period. So if you fast forward and you look at those same DSCR loans and you look at them and you go to August of this year, they were at 7.51%. So that was a drop of about 50 basis points just going to August prior to any sort of rate cut from the Fed. And so when you go forward and we just look at the data through September 22nd and you look at those same DSCR loans, they went down another 30 basis points or so. They're now trading at 7.22%. So we did see some rate movement there on the DSCR loans. But again, if the treasury rates went down a full 100 basis points, what happened on the DSCR side, they didn't do that full amount. They're down to about 80 basis points when you track them compared to what was happening in the treasury rate market. So there may be even some more room to go for DSCR loans. Now let's look at the short-term loans, the bridge loans. Some call them RTLs or residential transition loans or ground up or fix and flip. All of those loans are always a short-term duration. They're usually 12 months. And so what you can expect in this situation is that the Fed interest rate environment doesn't have that much of a correlation, and that proves to be true. When we go back to April for those loans on a national basis at 11.33%, and they went down in August to 11.11%. I just tracked them as well through September 22nd when I'm recording this video, and they stayed exactly the same at 11.11%, which shows you that the Fed interest rate environment does not have a direct correlation to that short-term bridge environment. And what makes sense there in terms of what you're going to see for leading indicators is how many capital market entrants are coming in. So for example, this year we've seen unrated securitizations, we've seen rated securitizations, so we've seen lots of capital deployed for these sorts of loans, and that's going to have an ability to reduce interest rates much more than what's happening on the Fed funds rate side of it. Hopefully this information has been valuable to you. We're always trying to figure out is how do we take what's happening in the world around you and apply it to your circumstances directly, and appreciate your time today.